Imagine getting an effective return of 45.3% on the very first day of investing. Sounds impossible, right? Well, it's possible through NPS, short for the National Pension System. Multiple changes have been announced in how NPS works. So today, I'm going to share what has changed in NPS 3.0, and I'm also going to break down exactly how you can get an effective return of 45.3%. Hello everyone, I am Uday Nanthe and I've been licensed in Indian financial services since 2015, and so far I've helped over 2000 families make better financial decisions. And here on my YouTube channel, I talk about all things money and personal development. Let's get right into the 45.3%, right? Because that will completely change how you think about NPS. So here's the setup. Under the new tax regime, your employer can contribute up to 14% of your basic salary plus DA into NPS under section 80cc D2. This entire contribution is not taxable. I'll share an example with you so this becomes absolutely crystal clear. So let's say your employer contributes 10,000 rupees per month towards your NPS. That entire 10,000 gets invested. But what if you did not opt for this employer's contribution and instead took that 10,000 rupees as salary? Now you'd have to pay tax on the salary you receive, right? So it's taxable income. And only after paying tax would you be able to invest with the remaining amount. So first up, some context: if you're in the 30% tax bracket, you actually pay 31.2% tax because of health and education cess. So at that tax rate, to have 10,000 rupees left to invest, you would have to earn 14,534 rupees before paying income tax. Because 31.2% of 14,534 is 4,534. So that amount goes straight to the government. And only after paying that, you're left with 10,000 rupees. So when your employer invests 10,000 for you, you're essentially saving on paying that tax. 4,534 divided by 10,000 equals 45.34%. That's your day one risk-free return before the market even moves, just because of how your salary is structured. At the same time, the entire maturity amount in an NPS is completely tax-free. In mutual funds, you have to pay a 12.5% capital gains tax on whatever gains that you have made, as long as you've held them for more than 1 year, and every year you get 1.25 lakhs tax-free. But because of this massive tax advantage, an employer's NPS contribution is one of the most powerful tax-saving strategies in India. And yet, hardly anyone uses it and most people misunderstand it. Obviously, the returns that you get from an NPS investment are important, because what's the point of this tax benefit if the returns are substandard, right? And I'll get to that in just a moment. I'll share exactly what the returns are. At the same time, a certain amount of the NPS maturity amount, 40% to be specific, has to be invested in an annuity. What it is, and for many people, this is a big concern and a big drawback, and I'll address that at the end of the video as well. First, to set the foundation, it's important to talk about the massive changes that have been implemented in NPS from 1st October 2025. I'm calling this NPS 3.0 and it has 4 big changes. First up, you can now invest 100% of your money in equities or stocks. Earlier, equity allocation across NPS schemes was capped at a maximum of 75%. That cap is gone. Under the multiple scheme framework, you can go all in on equity if you want. Now, of course, equity means higher volatility, but if you're young and have time on your side, that volatility actually works in your favor. Then number 2, earlier, once you invested in an NPS scheme, you had to stick to that scheme for all your future investments. That is no longer the case. As an NPS investor, you can now select different schemes, not just one. Number 3, under NPS 3.0, fund managers can launch multiple schemes even within the same equity or debt categories. And you can hold more than one of them inside the same NPS account. So instead of being logged into just one style or one NPS manager, you can now have diverse schemes. You can build a diverse portfolio, one aggressive, one more balanced, all within NPS. Now, existing NPS subscribers can't move their current investments from the common schemes existing today to the new MSF structure. So if you want to avail this benefit, you must open a separate account to invest in MSF. At the same time, you cannot switch from one MSF scheme to another before 15 years. Then the fourth and the final big change, the fee structure has changed. The fees have gone up slightly from around 0.03 to 0.09% earlier to now potentially 0.3%. But even at 0.3%, NPS is still way cheaper than most mutual funds that charge anywhere between half to 1% or even more. Now, with that being said, let's focus on the returns that NPS has generated so far, because that becomes fundamental, right, to all of this. If you look at the oldest NPS schemes in India that have been around for at least 10 years, you'll come across these 6 schemes. Now, you'll see basically different NPS managers, right? From HDFC to UTI and everyone in the middle. Look at the returns. They've ranged from 13.11 to about 14.72. If you look at the average return, it's 14.13 across these 6 schemes. And this is as of 8th December 2025, so it's as latest as it can get. Now, NPS schemes predominantly invest in large cap stocks. So let's see how large cap mutual funds in India have done across a 10-year window. And by the way, this link, NPS Trust, the official returns, you can access them, verify them. The link is available in the description. Even the link to the large cap fund that I'm showing you, it's available in the description. I'm not focused on this one large cap fund. I want to scroll down and I want to look at how equity large cap as a category has done in the past 10 years. You will straight up see that the return here is 14% as a category average. So straight away, right, NPS has generated 14.13. A large cap mutual fund has generated 14%. So it's already higher. And you'd be surprised to know that, right? Large cap mutual funds invest all their money in stocks, right? They can invest all their money in stocks, 100% of it. Whereas NPS until now could only invest 75% of its money in stocks. So despite having a lower allocation to stocks, it has actually generated higher returns. Now you may wonder that, okay, I mean 14 and 14.1, there's not much of a difference. And that's true. 0.1% really doesn't matter in the long run. But that is where the tax advantage comes in, and this sheet, once again, you can access it through the link in the description. This sheet will tell you how that tax benefit plays out over someone's career, right? So we'll use the same example where we put in our monthly investment amount, what we want to invest. We'll see how that would fare in NPS and how that would fare with mutual funds, right? So I'm just going to enter 10,000 here. So there we go. And because NPS is connected to your salary, right? Basic salary plus DA. It's also dependent on how your salary changes, how your salary increases. So let's say you have a generous boss and let's put the annual increment to be 7%. Now here the NPS contribution becomes 10,000. But if you take that as salary and your employer doesn't contribute it directly to your NPS, then you have to pay income tax on it. As I told you earlier, if you are in the 30% tax bracket because of health and education cess, your effective tax rate is basically 31.2%. So what is left for you to invest is 6,880 rupees. There's a lot happening here. Just follow where my mouse is going and focus on what I'm talking about, right? So let's look at year number 1, right? I have entered, by the way, the returns that have been generated by NPS and by mutual funds. So I'll just make this 14.1. You'll straight up see that in the first year, the amount that gets invested in an NPS is the entire 10,000, right? So 1,20,000 gets invested. Whereas with mutual funds, that is 82,560 rupees, because again, the difference is basically the tax you're paying to the government. At the same time, here's what I want you to focus on, right? Over this entire 35-year career, you would have invested 1.49 crores in an NPS. But if you're again just not using NPS, just using mutual funds, you're basically investing 1.14 crores. That difference of about 35 odd lakhs, that is the difference in how much tax you've paid to the government. And the magic of this is because you simply have more money invested in an NPS compared to a mutual fund. When compounding starts to show its magic, you're compounding on a higher base. Let me share an example, right? Look at year number 10. So in year number 10, just because you've been investing higher amounts in an NPS, your investment value is 34 lakhs. Whereas in mutual funds, that is 23 lakhs. That's the difference. And because the returns are very similar, right? I mean, I would say they're the same. 0.1% doesn't really matter. But because they're the same, just because you're investing higher amounts, it starts working to your advantage. And then that advantage just keeps getting more and more stark, right? As we go down the years. So in year number 35, so I'm considering a 35-year working career, this sheet is entirely yours to edit. So you can enter your own values and figure out, right, what works for you. But over a 35-year career, the NPS maturity amount is 17.2 crores. Look at the mutual fund maturity amount, 11.75 crores. Huge difference, right? Huge difference. At the same time, the entire NPS amount is not taxable. So you have that entire amount available to you. Whereas with mutual funds, you are paying a tax. And the tax, the headline rate is 12.5%, but even there, a cess is imposed. If your income is above 50 lakhs or above a crore, then a surcharge is imposed. If you just ignore the surcharge, if you just consider cess, the actual tax rate is 13%. So at that rate, on this 11.75 crores, you're paying a 1.5 crore tax. So your post-tax amount is 10.22 crores. There's no comparison, right? Just look at it. 17.2, 11.75, 17.2, 10.2 crores. There's no comparison. Now, yes, the entire NPS amount cannot be withdrawn in one go. You have to invest, I mentioned earlier, in something called as an annuity. I'll explain what that is. But 40% of this amount, 17.2 crores, has to be invested in an annuity. So you have 60% of the money available to you. How much is that 60%? Just look at this. Just look at this. It's 10.32 crores. This is also higher than the 10.22 crores that you have available post-tax in a mutual fund. Isn't that mind-boggling? Right? Isn't that mind-boggling? Now, the remaining amount has to be invested in an annuity. Now, the way an annuity works is, in this case, let's say this 6.88 crores you would give to a life insurance company. And there's a bond that you sign with the life insurance company, which is called an annuity, which says that you are guaranteed to get a certain interest on this amount every single year. And there are different types of annuities where at times you don't get the money back if you pass away. At times you get the money back if you pass away. It could be joint with your spouse. It could be individual. The current annuity rate in India from a good reputed life insurance company is about 6.8%. It ranges between 6.2 to 7%. So 6.8 is the current rate from a reputed life insurer for a single person annuity plan, where if you pass away, then basically this 6.88 crores goes back to your nominee, whoever you have named. But until you're alive, right? Until you're alive, you keep getting 6.8% of 6.88 crores, which is 46 lakhs every year, more than that. The thing is, on the annuity though, you have to pay income tax because that income is entirely taxable. So again, let's say you are in the highest tax bracket, you would pay about 14.5 lakhs of tax on it, which comes to a significant amount, right, over a 30-year window. But despite that, the total difference is 2.59 crores. And what is mind-boggling, I keep going back to it, right? Just look at this. This 60% amount of the annuity is still higher than the mutual fund final value post-tax. Again, this Excel sheet is available to you in the description. Just make a copy of it and you can edit it, put your values, see if it makes sense to you, see if it works out for your salary, for your numbers. Now, one thing that you might have spotted or not, I don't know, but just look at this, right? From year 29 onwards, the annuity amount is capped at 7.5 lakhs. That's because that's the highest contribution that you can get through an employer's contribution in an NPS every single year as of current taxation laws in India. So we've accounted for basically everything that you can account for. Check it out. If it still makes sense to you, I want you to look at NPS with clear, open eyes, right? Because there's a lot of misunderstanding as to how NPS works. If you want to apply what I share here on YouTube to your own life and investing, check out my program, The Complete Guide to Mutual Fund Investing. It has all my years of experience of being licensed in Indian financial services since 2015. In it, I've covered topics like how you can select mutual funds to invest in, how to build your mutual fund portfolio, a much deeper dive than this particular video, what is an SWP and how to plan for your various goals, among other topics as well. The guide also has Excel tools like this one, where you just enter the goal that you have, the money that you require for it, and it automatically tells you, factoring in inflation, how much you need to invest per month from now onwards and which mutual funds to go for to save for that goal. Once you sign up for the guide, you'll also be part of our monthly live Q&A sessions where I answer all your doubts. To check out the program, go to the first link in the description and the pinned comment. If those calculations were not enough, let me break down a few more proposed reforms that have not been finalized yet, but if they get approved, NPS gets even more attractive. And before I even share those with you, it's extremely important to understand that NPS, even in its current form, is absolutely fantastic. These people keep calling it different names for a bunch of reasons. The first proposed change is a reduction in the mandatory amount that you need to invest in an annuity. Currently, you saw that you have to invest 40% of the NPS maturity amount into an annuity. The proposed change is to reduce this from 40% to 20%. Annuity is a big thorn, is a big point of contention for a lot of people who want to consider investing in an NPS. And I'll address this point right at the end, right, as to why that may not be the worst idea or its impact is not as bad as you think. I'll address that. The second proposed change addresses one of the other big complaints about NPS, which is the lock-in. Right now, your NPS matures when you turn 60 years old. The regulator is considering reducing the lock-in period to 15 years. So let's say you start off at the age of 30, by the age of 45, the NPS money could be accessible to you if this reform does get approved. The way I think about it, the longer lock-in, right, for some, even a 15-year lock-in may seem like a lot, but the longer lock-in is actually a feature, because when the markets are not doing well, when there's a big drop in the market, I know a lot of people who redeem their investments. They panic sell, right? They're not sure what will happen. So they just feel, okay, I don't want the value of my money to go down further. So they just sell their investments. That gets in the way of your money compounding, because market drops, market crashes are a part of any investor's journey. In fact, in Paisa Vaisa's episode where one of India's leading NPS managers spoke about NPS, he addressed this point as to how having that lock-in forces someone to be disciplined. I've again linked that video in the description, so definitely check it out. The third proposed change extends how long you can stay invested in an NPS. Currently, you can remain invested in an NPS until the age of 75. The proposal is to push it to 85. This again matters because it allows you to stay invested for longer periods of time. So your money compounds tax deferred for an extra decade. If you don't need money at 60, why would you want to pull it out and lose that growth potential, right? Now the big question that everyone asks me all the time, should I invest in NPS or mutual funds? And here's how I think about it. Both offer different benefits, right? NPS gives you that big tax break at the start. It also has extremely low fees, and it sort of forces you to be disciplined and save for your retirement. At the same time, mutual funds are very flexible. You can invest in a mutual fund and take that money out in 3 years, 2 years, 1 year, 10 years. And while retirement is one goal of your life, you have multiple other goals, right? And those goals take place anywhere between 1 year to 25, 30 years down the line. But here's the thing that most people miss. It's not an either or. The smartest strategy is to use both because they complement each other so well. Use NPS, the employer's contribution part, to maximize your tax benefits. Then use your mutual funds for goals that need more flexibility, like buying a house, kids' education, travel, and everything in between. Think of NPS as your locked retirement money that grows with massive tax advantages. Think of mutual funds as your flexible wealth building vehicle. But if you simply ignore NPS as a salaried professional, then you're leaving serious money on the table. At least give it a thought, right? Crunch the numbers for yourself, see how it works for you, and then take an informed decision rather than acting out of just complete unawareness about this. And finally, with regards to annuity, because it's an important point to talk about, I want to make 3 points. The 60% of the money that you can take out in an NPS at the age of 60 is actually still higher than your entire mutual fund investment value. And the almost 7 crores that you have to invest in an annuity in our example is like a bonus. So either way out, you are winning. Secondly, in a well-planned retirement portfolio, you ideally would always allocate some amount, some part of your portfolio to an annuity, which gives you a guaranteed fixed interest no matter how interest rates are moving in your country. That is why strategic allocation to an annuity is actually a good idea. In fact, let me tell you that I actually know people who got annuities 15, 16, 20 years before. And at that rate, because interest rates in India were higher than they were today, they are getting 10 to 12% fixed return on whatever amount they invested back then. Just think about it. Right now, the rate I showed you was a little under 7%, which is like a good fixed deposit, right, today. But imagine getting 12%, 10% guaranteed on the amount that you're investing. And then tied into that, point number 3. If about 14% of your basic salary plus DA gets invested in an NPS through the employer's contribution, think about it. You ideally have about 3 to 4 times of that NPS contribution available to you to invest in mutual funds. So the impact of that annuity, even though 7 crores may have seemed like a huge number, and it is, it's substantial. But even then its impact is not as much because that annuity amount that you have to invest is going to be a smaller part of your overall portfolio. So the impact is minimalized to a great extent. So here's what I want you to walk away with. Seriously consider NPS investing, especially your employer contributing to your NPS account. And if you enjoyed watching this one, then check out my video where I talk about how to invest for your short-term goals. And I'll see you in the next one.